Welcome, dear students and scholars. In this first lesson on ASC 320, Debt Securities, we are building the big picture before going into detailed rules and calculations. Under US GAAP, Accounting Standards Codification Topic 320 explains how debt securities are classified and measured after purchase. The basic idea is simple but powerful. The same bond can be held, traded, or kept available for sale, and that classification changes the financial statement result. If the bond is held to maturity, we think about amortized cost. If it is trading, fair value changes go straight into earnings. If it is available for sale, fair value changes generally go through other comprehensive income and accumulated other comprehensive income. So, in this standard, the label is not decoration. The label controls measurement, income statement effect, and balance sheet presentation. Now, look at this important idea. The same bond can create different reporting outcomes. The issuer can be the same, the coupon can be the same, the maturity date can be the same, and the contractual cash flows can be exactly the same. But the accounting can still change because management's intent and ability are different. A bond does not wake up in the morning and say, "Today I feel like trading." The company's purpose for holding it drives the accounting. Interest income may still go to earnings under all categories, but fair value changes may go to earnings for trading, to OCI for available for sale, or may not be recognized for held to maturity. So remember this line: same bond, different intent, different reporting. Before we classify anything, we need to check scope. ASC 320 does not cover every debt like instrument or every entity. It generally applies to debt securities held by non specialized entities, and it can also apply to loans that meet the definition of a security under US GAAP. If a host debt instrument remains after an embedded derivative is bifurcated under ASC 815, the host may still be under ASC 320. But specialized entities such as brokers, dealers, and investment companies often use specialized fair value models. Not for profit entities, derivatives under ASC 815, and investments in consolidated subsidiaries are outside this topic. This is why scope is the first gate. If you enter through the wrong gate, every answer after that may look confident but still be wrong. Classification starts at purchase. This is not a year end decoration exercise where management looks at market prices and then chooses the most comfortable label. At acquisition, management must document the purpose for holding the security and whether the entity has the ability to carry out that purpose. After that, the classification is reassessed at each reporting date. The practical question is, what are we doing with the security and can we actually do it? If the answer is hold to maturity, there must be evidence. If the answer is trade in the near term, the earnings model applies. If the answer is neither, available for sale may be the result. Good documentation is not just paperwork, it is the accounting evidence trail. In accounting, undocumented intent is like a calculator with no batteries. It may look useful, but it will not support the answer. ASC 320 organizes debt securities into three reporting buckets. The first is held to maturity or HTM. This requires positive intent and ability to hold the debt security until maturity, and the measurement basis is amortized cost. The second is trading. These securities are held principally for short term sale in the near term, and they are measured at fair value with changes recognized in earnings. The third is available for sale or AFS. This is generally the residual category when the security is neither HTM nor trading. AFS securities are measured at fair value, but unrealized holding gains and losses usually go to other comprehensive income, not current earnings, until realization. This grid is the heart of the standard. If you master this slide, the remaining ASC 320 videos become much easier. Held to maturity sounds simple, but it carries the highest evidence requirement. Management must have both positive intent and demonstrated ability to hold the debt security until its maturity date. Saying we plan to hold it is not enough. The company must be able to support that claim with liquidity planning, investment policy, and facts that make holding realistic. HTM securities are reported at amortized cost, meaning the carrying amount reflects original purchase price adjusted for premium or discount amortization over time. Interest income is recognized using the effective interest method. Interim fair value changes are not recognized in earnings or on the balance sheet for HTM measurement. Think of HTM as the serious, disciplined student in the class. It does not panic every time market interest rates move, but it must prove it really intends to stay until the end. Trading securities are the opposite personality. These are purchased and held principally for sale in the near term, usually to profit from short term price movements. Because the holding period is short by design, US GAAP sends fair value changes directly into net income. At each reporting date, the security is marked to fair value, and unrealized gains and losses run through the income statement even before sale. When the security is actually sold, realized gains and losses also go to earnings. Trading is the most talkative category in the ASC 320 family. Every market movement quickly shows up in income. That can create earnings volatility, but that volatility is exactly the point. If the purpose is active short term trading, the financial statement should reflect that current market movement. Available for sale securities sit between HTM and trading. They are reported at fair value on the balance sheet, but unrealized holding gains and losses generally do not pass through net income while the security is still held. Instead, those changes go through other comprehensive income and accumulate in accumulated other comprehensive income within equity. This is why the slide calls it fair value with equity parking. The gain or loss is not ignored, it is parked outside earnings until realization. Interest income still goes to earnings each period. When the AFS security is sold, the cumulative AOCI amount related to that security is reclassified into net income. So AFS is not no income statement forever. It is more like not yet, but keep the file ready. ASC 320 also connects with several other standards, and this matters in real practice. ASC 320 gives us the classification and measurement framework for debt securities, but it relies on other topics for related questions. ASC 320 connects with ASC 326 for credit losses, ASC 820 for fair value measurement, ASC 825 for financial instruments and fair value option issues, ASC 815 for derivatives and hedging, and ASC 220 for presentation of other comprehensive income. The key is not to turn every ASC 320 question into a research vacation. Use the related standards as boundaries. If the issue is fair value measurement, go to ASC 820. If the issue is derivative features or hedging, go to ASC 815. Boundaries save time and reduce mistakes. Let us close with the memory path for this entire topic. Classify, measure, locate. First, classify the debt security as HTM, trading, or AFS based on management's purpose and demonstrated ability at the acquisition date. Second, measure under the category amortized cost for HTM, fair value for trading and AFS, and effective interest for interest income. Third, locate the gain or loss. Trading changes go to earnings. AFS unrealized changes usually go to OCI and AOCI. HTM unrealized fair value changes are not recognized unless another issue, such as impairment or realization, changes the analysis. In the next video, we will go deeper into classification judgment and held to maturity securities, including what can support or damage HTM classification. Please like, share, subscribe, support the channel, and share this video with your colleagues who are learning US GAAP with you.